Okay, let's unpack this. You've done the work, maybe got the degree, but then you're facing that big reality. Student loan debt.
Yeah, that feeling of just being totally overwhelmed by the numbers.
Exactly. And you are definitely not alone in that.
Not at all. I mean, the scale is just immense. The source material we're looking at, SideBySide, points out, as of 2025, you've got over 44 million Americans.
44 million.
Holding about, what, $1.75 trillion in student debt? It really shapes people's financial lives.
It does, absolutely. That pressure is so real. But here's where diving into this side-by-side guide gives us some actual good news. This doesn't have to be some permanent weight hanging over you. With, smart, informed strategies, you really can take back control.
Yeah, and potentially save tens of thousands of dollars. That's not small change.
Not at all. So our mission here in this deep dive is really to pull out those key proven strategies from this material.
Right. The nuggets covering everything from repayment plans, understanding refinancing,
forgiveness programs, even those little financial hacks. We want to help you figure out what's most important here.
So maybe let's set the stage first. Like, why is this such a huge challenge for so many people right now?
Good question. Well, you have to look at the context. The source highlights. The cost of education has just, ballooned.
Ballooned is the right word. The National Center for Education Statistics says tuition at public universities, it's tripled since 1990.
Tripled. Wow. And then you compare that to wages for young adults,
which haven't kept pace at all. Not even close.
So that gap, it creates this situation where students often just have to borrow more, right?
Exactly. More borrowing, sometimes without a really clear plan for how they'll handle paying it back once they graduate.
And you hear these stories, like Sarah's, which the source shares. First in her family to go to college, believed in the dream.
Totally.
But then found herself juggling multiple jobs, just struggling to make those minimum payments.
It really shows that pitfall, doesn't it? Borrowing based on this idea of future income without a solid plan for the repayment reality that hits right after graduation.
Yeah, her story really underscores why understanding your options, like early on,
either while you're still borrowing or just as you start repayment,
is absolutely crucial. It helps you avoid that struggle. Knowledge really is power here.
So true. So if someone's feeling that pressure right now, where does the side-by-side guide say they should even start? Like, what's step one?
The foundational step, especially if you've got federal loans, is picking the right repayment plan.
Right. And this isn't like a one-size-fits-all thing. The plan you choose, it can drastically change your long-term cost and maybe more importantly, your monthly cash flow.
Okay, let's break down those main federal options the source talks about. First, there's the standard plan.
Pretty straightforward, yeah. Fixed payments, 10 years.
It pays off the debt the fastest, which means less interest paid overall.
But those monthly payments are usually the highest. That's the trade-off.
Then you've got the graduated plan.
Okay, how's that work?
Payments start lower.
Okay.
And then they increase every 2 years.
Yeah.
So it could work if you're pretty confident your income's going to grow steadily.
Right, if you're expecting raises early in your career. Makes sense.
And then we get into the income-driven repayment plans, IDR. This is where it gets really interesting, I think, for a lot of borrowers struggling with those high monthly payments.
Yeah, what's fascinating here with IDR plans and the sourceless examples like Repay, Payee, IBR, ICR, is that your monthly payment isn't just based on your loan balance.
Right. It's tied to your income.
Exactly. It's calculated each year based on your current income and your family size. That can make a huge difference in your budget.
The source gives David's case study, and it really hits this home. He's a social worker making $42,000.
Okay.
He switched to the Payee plan, and his monthly payment dropped from $550, wait for it, down to $190.
Wow. $550 down to $190. That is a massive difference in monthly cash flow.
Huge. It doesn't necessarily speed up the debt payoff, obviously.
No, it might even extend it, but it makes things manageable day to day, reduces stress, lowers the risk of default.
And for David and others on IDR, there's that potential light at the end of the tunnel. The remaining balance could be forgiven after 20 or 25 years of payments.
That's a key part of the appeal for many. Now, what are the important tips the guy gives for managing IDR?
Well, number one, reassess your plan every single year. You have to recertify your income anyway.
Right, because your income or family size might change, and that could affect which plan is best or what your payment should be.
Exactly. And for married borrowers, the source notes something interesting.
Oh, yeah.
How you file your taxes jointly or separately can sometimes impact your IDR payment calculation. So that's a detail worth looking into.
Definitely something to be aware of. Okay, so that's managing payments based on income. But what if you want to attack the interest rate itself?
Right. That leads us to refinancing and consolidation. People often confuse these, but the source makes it clear they're quite different.
Yes, a really critical distinction. Consolidation, that's only for federal loans.
Good.
You combine multiple federal loans into one new federal direct consolidation loan. It simplifies things, gives you one payment.
But does it lower your interest rate?
Not usually. The new rate is a weighted average of your old rates, rounded up slightly. So simplification is the main goal, not necessarily saving money on interest. And it stays within the federal system.
Got it. Refinancing, then, is the one involving private lenders.
Exactly. You take out a brand new loan, usually from a private bank or lender, to pay off your existing loans. Those could be federal or private loans you already have.
And the main goal there is usually getting a lower interest rate.
Almost always, yes. And the savings can be pretty significant. The guide uses Emily's example. She had $60,000 in loans, average interest rate around 7.2%.
Ouch.
Yeah. She refinanced down to 4.5%. Over the life of the loan, that saved her over $10,000 in interest.
$10,000. That's real money back in your pocket. But
yeah,
there has to be a catch, right?
Yeah.
What's the biggest risk, especially when refinancing federal loans into a private one?
Yes. This is the most crucial point. When you refinance federal debt with a private lender, you permanently, irreversibly lose access to all those federal benefits we just talked about.
So things like the IDR plans.
Gone.
Potential federal forgiveness programs like public service loan forgiveness.
Gone. You're giving up that entire federal safety net, the flexibility, the hardship options, the forgiveness pathways.
Wow. Okay, so that's a huge consideration. Given that massive downside, when does the guide suggest refinancing might actually be a good move?
It's generally looked at by folks who tick a few boxes. Strong credit score, usually 700 plus.
Okay.
Stable, reliable income. And crucially, they're very confident they won't need or won't qualify for any federal forgiveness or those income-driven payment plans.
There's really a calculation. You're betting on your financial stability and that the interest savings outweigh losing all those federal protections.
Precisely. It's driven purely by getting the lowest possible rate, and you have to accept that trade-off.
Okay, moving on from managing payments and rates. Let's talk about something that, for some people, feels almost like a myth. Loan forgiveness programs.
Yeah, it can feel that way, but the source actually quotes student loan expert Mark Kantrowitz saying something like, "Loan forgiveness isn't a myth, it's a reality for those who stay informed and meet the criteria."
Okay, so it is real for some people.
Yeah.
What are the key federal programs the guide outlines? Public Service Loan Forgiveness, PSLF, that's a big one.
Huge. This is the program that forgives the remaining balance on your federal direct loans after you've made 120 qualifying monthly payments.
That's 10 years of payments.
Right. While working full-time for a qualifying employer that's generally government at any level, federal, state, local, tribal, or an eligible 501c3 nonprofit.
Okay, what else?
Then there's teacher loan forgiveness. This one can forgive up to $17,500 for teachers.
Specific amount there.
Yes, but they have to teach for 5 consecutive full academic years in a designated low-income school or educational service agency.
Got it. And we also mentioned the forgiveness tied to the IDR plans earlier, right?
Exactly. After 20 or 25 years of making those income-based payments, whatever remaining balance is left may be forgiven.
Though, important point, the source might mention that forgiven amount under IDR could potentially be treated as taxable income.
That's a critical detail to be aware of, yes. Unlike PSLF forgiveness, which is generally not taxed federally.
And the source also mentioned some recent developments, particularly around PSLF, things changing in 2024 or 2025.
Yes, that's definitely worth noting. There was a significant PSLF overhaul mention, which aimed to simplify the really complex eligibility rules.
Made it easier for people.
Supposedly, yes.
Right.
And it actually fast-tracked forgiveness for thousands who'd been stuck or thought they didn't qualify before. There were also temporary waivers that allowed borrowers to get credit for past payments that wouldn't have counted under the old, stricter rules.
That sounds like a really big deal for people who'd been trying for years. So what are the key tips the guide gives for someone trying to maximize their chances with forgiveness, especially PSLF?
Documentation and diligence are key. The source strongly emphasizes certifying your employment annually using the official PSLF form.
Why annually?
It helps ensure your payments are being tracked correctly by your servicer and flags any potential issues early on rather than finding out years down the line there was a problem.
Makes sense. What else?
You absolutely need to be on an eligible repayment plan. For PSLF, that usually means one of the IDR plans.
Because those payments count towards the 120?
Yes, the 10-year standard plan also counts. But often the goal with PSLF is to have a balance left to forgive after 10 years, which is more likely on an IDR plan. And critically, track every single payment yourself. Check your servicer's records regularly.
Okay, so diligence is key. We've covered managing payments with IDR, lowering rates with refinancing, pursuing forgiveness. But what about just like practical things you can do today to chip away at the debt faster?
Ah, yes, the smart payment tactics. The guide details several ways to save money and reduce that total interest paid without necessarily changing your whole plan.
These sound useful. What's one example?
Making bi-weekly payments. Sounds simple, but it's effective.
How does that work exactly?
You basically split your standard monthly payment in half, and you pay that half amount every 2 weeks.
Okay, so that's 26 half payments a year.
Exactly, which equals 13 full monthly payments instead of the usual 12.
So you sneak in one extra payment each year without really feeling it as much.
Precisely. And that extra payment goes directly towards your principal balance, reduces the principal faster, which means less interest accrues over the life of the loan. It can actually shave years off your repayment time.
Nice. What other tactics?
Using windfalls wisely. If you get a tax refund, maybe a bonus from work, even a cash gift.
Yeah, it's tempting to spend that.
Very tempting. But the guide suggests directing that money straight towards your loan principal. It makes a significant dent in future interest.
And there's a key detail there, right, about how you tell them to apply it.
Yes, you need to specifically instruct your loan servicer to apply that extra payment to the principal balance, ideally on your highest interest loan if you have multiple. Otherwise, they might just apply it to future payments or only cover accrued interest.
Good tip.
Well, something even simpler, consistently rounding up your payments.
Like if your payment is $237.
Pay $250, or if it's $480, pay $500, whatever you can manage. That little bit extra month after month really adds up over time, accelerates the payoff, saves interest. It's surprisingly effective.
That seems doable. Anything else straightforward?
Don't overlook enrolling in auto debit. Most loan servicers offer a small interest rate discount for it.
Usually like 0.25%, right?
Typically, yeah. It's not huge, but hey, every little bit helps. Plus, it guarantees you won't miss a payment, which is good for your credit score.
Definitely. Now, related to minimizing costs, the source advises trying to avoid deferment and forbearance if you possibly can. Why is that?
Well, those options let you pause your payments, which sounds great if you're in a tough spot financially. But interest on most types of federal loans, and definitely on private loans, usually keeps accruing during that pause. It doesn't stop.
And that accrued interest, it doesn't just vanish.
Nope. Often it capitalizes, meaning it gets added right onto your principal balance.
Oh, so when you start paying again, you're now paying interest on a bigger balance.
Exactly. So while deferment or forbearance provides temporary relief, it can actually increase the total amount you owe in the long run. They should be seen as temporary fixes, not long-term solutions, if possible.
Okay, that makes sense. Shifting gears a bit, the guide also looks ahead strategies for current students or parents trying to minimize debt from the get-go.
Yeah, planning ahead is crucial. The most effective strategy often starts before you even take out the loans.
Like borrowing only what you absolutely need?
Absolutely. Students should really focus on borrowing just for the true essentials, tuition, fees, books, necessary living costs. Not, for lifestyle upgrades. Every dollar borrowed costs more than $1 to repay because of interest.
That takes discipline.
Yeah.
What about paying while still in school?
If a student can manage it, even making small interest-only payments while they're still enrolled can be a really smart move.
What is that?
It prevents that unpaid interest from capitalizing, from getting added to the principal balance before repayment even officially starts. It keeps the starting debt lower.
Makes sense. And scholarships and grants.
Pursue them aggressively. Every single dollar you get from a scholarship or grant is a dollar you don't have to borrow.
And therefore don't have to repay with interest.
Exactly. Start searching and applying early and often.
The guide also mentions considering lower-cost school options.
Yeah, that can make a massive difference in the total debt load. Thinking about starting at a community college for the first couple of years or really prioritizing public in-state universities.
Often significantly cheaper than private or out-of-state schools.
Definitely. It requires maybe rethinking the dream school idea sometimes, but the financial impact can be huge.
And ultimately, the source really emphasizes the value of financial literacy education for students.
So important. Just understanding the long-term implications of borrowing before you sign on the dotted line can prevent poor decisions and set students up for much better financial health after they graduate.
What about parents looking to help?
For parents planning ahead, the guide suggests exploring tax-advantaged savings plans like 529 plans.
How do those help?
They let you save and invest money specifically for education expenses, and the money can grow tax-deferred, and withdrawals for qualified expenses are often tax-free. It reduces the need for loans down the road.
Okay, we've covered a ton of valuable strategies here, but it's also important, as the source points out, to acknowledge the complexities, the potential pitfalls. It's not always straightforward.
That's right. We need to be realistic. While those federal forgiveness programs are real, they can be complicated to navigate. Historically, there have been issues like mismanagement by loan servicers, unclear rules, and these programs can be subject to political changes too.
So what's the advice there?
The guide really stresses keeping meticulous records. Document everything if you're pursuing forgiveness. Copies of payment confirmations, employment certifications, everything.
Good advice. And we touched on the risks of private loans and refinancing federal debt earlier.
Yes, worth reiterating, private loans just don't have those federal protections. No IDR, no federal forgiveness options, less flexibility during hardship. They really should be a last resort after exhausting federal aid.
And that idea of refinancing regret.
Right. Once you refinance federal loans into a private loan, you generally cannot go back. You've permanently lost access to those federal benefits like IDR and PSLF eligibility. It's a final decision, so you need to be sure.
And finally, the source brings up something really important: the emotional toll.
Yes. This isn't just about numbers on a page. Student debt can significantly impact mental health, cause stress, strain relationships.
It can even influence career choices, right? Maybe stop someone taking a lower-paying public service job they love because they need higher income for private loan payments.
Exactly. The guide mentions that seeking support, whether that's from financial advisors who specialize in student loans or even online communities and support groups, can be really helpful.
Just connecting with others who get it or getting expert advice can provide perspective and practical guidance.
Definitely.
So as we wrap up this deep dive, I think the core message coming through from the side-by-side material is pretty clear. Student loans are a major factor for millions.
But they don't have to dictate your entire future.
Exactly. By being proactive, getting informed,
Like choosing the right repayment plan for your situation right now.
carefully weighing refinancing if it truly aligns with your long-term financial picture and risk tolerance.
Understanding and actively pursuing forgiveness, if you might qualify.
Using those smart payment tactics to pay things down efficiently.
And planning wisely if you're still on the path to college.
You really do have the power to manage this debt instead of letting it manage you.
Yeah, take control. Don't feel like you need to tackle everything at once, though.
Good point. Maybe just think about taking one actionable step today, something based on what we discussed that resonated with you.
That could be as simple as logging into your loan servicer's website just to confirm, okay, what is my current repayment plan?
Or using an online calculator to estimate what your payment might be on an IDR plan.
Or just checking if you're enrolled in that auto debit for the interest rate discount. Taking that one small first step can feel really empowering.
Absolutely. Because, as the guide reminds us, every dollar you manage to save in interest.
That's a dollar you're freeing up. Money you can invest in your own future, your own goals, your dreams. It's about unlocking your financial potential.
And, continuing to explore resources like SideBySide or others is important. Keep learning, stay informed as things change.
The landscape does shift, so staying updated is key.
So as you think about putting these strategies into action for yourself, maybe you're starting to wonder, how does managing this debt, or maybe refinancing, impact my credit score over the long haul? Or perhaps you're curious about the latest developments around student loans and bankruptcy or things changing there. Just, some things to keep chewing on as you continue your own journey navigating this complex but definitely manageable challenge.